This script is designed as the first installment of a 5-part series titled The Final Act. It utilizes current data as of December 20th, 2025, to construct a high-impact contrarian narrative. This first part focuses on the inversion of truth, the moment where the strongest market narratives collide with the coldest mechanical realities. The Great Denial. The mechanical reality of the global financial system has entered a phase that history will remember as the Great Denial. The Great Denial. As of December 20th, 2025, the headlines are almost universally celebratory. The S&P 500 has notched yet another record high. The AI supercycle is being hailed as the permanent end of the business cycle. And the Federal Reserve has successfully navigated a soft landing while keeping inflation at a sticky but manageable 3%. To the average observer, the machine is humming. But the contrarian looks not at the humming of the engine, but at the heat it is generating. We have reached the final act of a credit-fueled cycle that began in 2009, a 17-year odyssey of paper wealth that is now detaching from the physical laws of economics. The final act is characterized by a specific phenomenon, the inversion of truth. This is the stage where bad news is interpreted as good news because it implies more liquidity, and where risk is redefined as opportunity cost. If you aren't fully invested in the vertical move, the narrative says you are losing. But in the final act, the move vertical isn't a sign of health. It is a melt-up, the final violent gasping for air before the oxygen is cut off. Check the 4 stages of the narrative trap. To understand why 2026 is the event horizon, you must recognize the 4-stage pattern of the narrative trap. Stage 1, the fundamental rise, 2016-2020. Markets grew based on earnings, innovation, and low interest rate stability. Stage 2, the stimulus distortion, 2021-2023. The system was injected with $10 trillion in global liquidity. Value was no longer discovered, it was manufactured. Stage 3, the parabolic delusion, 2024, late 2025. This is our current location. Valuation metrics have been discarded. The Shiller PE ratio is screaming at levels seen only in 1929 and 2000, but the narrative says this time is different because of AI productivity. Verified. Stage 4, the liquidity snap, 2026. This is the coming reality. This is the moment when the market realizes that productivity cannot pay back $300 trillion in global debt. The snap is not a slow decline, it is a total loss of bid. The cockroaches in the machine. In the final act, the warning signs, what Jamie Dimon calls the cockroaches, begin to emerge in the shadows. While the Mag 7 and AI darlings dominate the index, the foundation is crumbling. The subprime unraveling. In late 2025, we are seeing the highest delinquency rates in subprime auto loans and credit cards since the 2008 Great Financial Crisis. The consumer that drives 70% of the US economy is exhausted. They are no longer spending income, they are spending the last of their credit limits. The yield curve deception. After the longest inversion in history, the yield curve has finally uninverted. Historically, the crash doesn't happen when the curve is inverted. It happens when it uninverts. This is the signal of the end. It means the recession is no longer forecast. It is a present reality that the bond market is finally pricing in. The institutional surrender. As of December 2025, cash levels in professional portfolios are at record lows. Even the most cautious bears have been forced to chase the rally to keep their jobs. This is the definition of institutional surrender. When there is no one left to buy because everyone is already 100% all in, the only direction left is down. Undeniable. The sovereign debt event horizon. The ultimate final act warning lies in the math of the sovereign. On December 15, 2025, the U.S. Treasury confirmed that interest payments on the national debt have officially crossed the $1.1 trillion mark annually. We are now spending more to rent our past debt than we are to defend our future. The machine is currently in a fiscal doom loop. To pay the interest, the Treasury must issue more debt. To sell that debt, the Fed must eventually monetize it, which stokes inflation. If they don't monetize it, yields spike and the banking system breaks. This is the checkmate position. There is no soft landing for a math problem this large. The 2026 prediction is not about a market correction. It is about a sovereign re-rating. The prima final act is the moment the world realizes the for risk-free asset, U.S. Treasuries, is the greatest concentration of risk in human history. Verified. The behavioral exit. The contrarian doesn't wait for the fire to start. They watch the exits. In the final weeks of 2025, we are seeing insiders and founders selling their shares at the fastest rate in a decade. While they tell the public that AI is the fourth industrial revolution, they are swapping their paper claims for kinetic assets. They are buying the farmland, the gold, and the bunkers. Actionable insight. For part 1, Stop looking at the price, start looking at the liquidity. The Meltdost melt-up is designed to trap the maximum amount of retail capital before the final act curtain falls. Tighten your stops. Do not let greed turn a 100% gain into a 20% loss. Build your dry powder. Cash is not trash when asset prices are vertical. Cash is the only weapon you have when the bid disappears. Watch the dogs of the Dow. When the laggards start to fly, the end is nigh. The machine is accelerating into a wall. The record highs of December 20th, 2025 are the siren song of the final act. Don't be the one still in your seat when the lights go out. The AI mirage, we will expose why the productivity promise is a 2026 debt trap that will liquidate millions of portfolios. Subscribe to the revelation. The pattern is absolute. The mechanical reality of the AI supercycle has reached its most dangerous phase. As of December 20th, 2025, the narrative of infinite productivity has become the mandatory religion of Wall Street. Companies that fail to mention AI on their earnings calls are being ruthlessly derated, while those that do have seen their valuations swell by an average of 200% over the last 24 months. But a systemic revelation is emerging in the Q4 data. We are witnessing a productivity mirage. The machine is currently fueling a capex arms race. In 2025, capital expenditures by the 4 largest tech hyperscalers hit an astronomical $210 billion, and projections for 2026 have just been revised upward to $300 billion. This is the sunk cost trap. These firms are not investing based on current demand. They are investing based on the fear of being left behind. The mirage is the belief that this $300 billion in spending will instantly translate into a corresponding surge in global GDP. However, historical data from the solo computer paradox of the 1980s reminds us that you can see the computer age everywhere except in the productivity statistics. As of late 2025, while AI is generating poems and coding scripts, it has yet to move the needle on the total factor productivity of the broader economy. Check. The 4 stages of the AI debt trap. To navigate the 2026 collapse, you must recognize the 4-stage cycle of the AI debt trap. Stage 1, the speculative spark, 2023. The launch of large language models created the proof of concept, leading to a flood of venture capital into anything with an AI domain. Stage 2, the infrastructure build-out, 2024-2025. This is the current NVIDIA era. Huge amounts of debt are being issued to buy chips and build data centers. In December 2025, corporate bond issuance hit a record high as tech firms moved away from cash funding and toward debt-funded capex. Verified. Stage 3, the revenue friction, early 2026. This is the coming wall. Investors will stop asking about model parameters and start asking about return on invested capital, ROIC. The mirage begins to fade when companies realized they are spending $10 in compute costs to save $2 in labor. Stage 4, the margin collapse, late 2026. As the debt used to fund these mirage investments comes due and the expected productivity gains fail to materialize, margins will contract violently. This is when the AI supercycle becomes the AI liquidation, the circular revenue scandal. In the final act, the machine resorts to circular financing to maintain the illusion of growth. Latest intelligence from the December 2025 transparency audits suggests a disturbing pattern. Hyperscale tech firm A invests $5 billion into AI startup B. AI startup B then uses that $5 billion to buy cloud services and chips from hyperscale tech firm A. On the balance sheet, firm A reports record revenue growth, and startup B reports record funding. In reality, no new value is created. The same $5 billion just moved in a circle to inflate the valuation of both entities. This is the modern-day .com signal. In 2000, it was eyeballs and fiber optic capacity. In 2026, it is compute tokens and agentic workflows. When the circular funding dries up, the revenue growth doesn't just slow, it vanishes. Undeniable. The gray swan, the energy nexus. The ultimate physical limit to the AI mirage is not software, but electricity and water. As of December 20th, 2025, the AI energy nexus has become a national security crisis. A single AI query now consumes 10x the electricity of a standard Google search. In several US states, data center demand is now projected to consume 20% of the total grid capacity by 2026. This is the gray swan event. As the machine demands more power, electricity prices for the average citizen are spiking. The social license for AI is expiring. If the grid cannot sustain the mirage will be switched off by regulatory mandate. The 2026 final act will see a collision between the digital ambitions of the elite and the physical limits of the power grid. Verified. The behavioral exit. Follow the founders. The most damning evidence of the mirage is the behavior of the creators. Throughout Q4 2025, we have seen the largest insider selling in the history of the semiconductor and software industries. The very people building the future of humanity are swapping their stock for physical gold, land, and kinetic assets. They know that the current valuations require a level of perfection that the physical world cannot deliver. Actionable insight. For part 2, audit the earnings. Look for companies that are generating organic AI revenue, customers paying for a service, versus those simply reporting AI-enabled productivity, vague cost-cutting promises. Watch the utilities. In 2026, the real winners won't be the chip makers. They will be the power and water infrastructure providers who hold the physical keys to the digital kingdom. De-risk the hype. If more than 50% of your portfolio is tied to growth tech, you are standing on the edge of the mirage. The machine is promising a utopia to keep you in the market while the exit doors are being locked. The AI mirage is the most expensive hallucination in financial history. The ghost in the ledger, we will expose the hidden 100 trillion shadow debt market that is set to implode as the mirage fades. Subscribe to the revelation. The pattern is absolute. This is part 3 of the 5-part Final Act series. Having exposed the inversion of truth and the AI mirage, we now descend into the engine room of the collapse, the hidden $250 trillion global shadow debt market, the $250 trillion blind spot. The mechanical reality of the global economy is no longer managed by central banks. It is haunted by them. As of December 20th, 2025, the most dangerous force in finance is not the debt you can see, but the debt you cannot. While the public focuses on the $38 trillion US national debt, the final act is being written in the non-bank financial intermediation (NBFI) sector, commonly known as shadow banking. According to this Financial Stability Board's latest year-end data for 2025, shadow banks now control over $256 trillion in total assets. This represents 51% of all global financial assets. For the first time in modern history, the shadows are larger than the traditional banking system itself. These entities, hedge funds, private credit firms, and special purpose vehicles, operate with a fraction of the regulation and zero access to the Federal Reserve S-emergency discount window. In the final act, this is the ghost in the ledger, a massive interconnected web of leverage that has no lender of last resort. Check. The 4 stages of the shadow liquidation. To survive 2026, you must recognize the 4-stage pattern of a shadow collapse. Stage 1, regulatory displacement, 2010, 2022. After 2008, strict rules, Basel III, forced traditional banks to stop lending to risky businesses. This didn't eliminate the risk, it simply pushed it into the shadows where private credit funds stepped in to fill the void. Stage 2, the yield chase, 2023-2025. With traditional bonds offering poor returns relative to inflation, pension funds and insurance companies poured trillions into private credit. In 2025 alone, the shadow banking sector grew at twice the rate of traditional banks. Verified. Stage 3, the liquidity mismatch, early 2026. This is the coming friction point. Shadow banks perform maturity transformation. They take short-term money from investors and lend it out as long-term illiquid debt. When investors want their money back, the shadow bank has nothing to sell. Stage 4, the contagion, late 2026. Because traditional banks lend money to shadow banks, the ghost eventually drags the host down. A default in an obscure private credit fund in 2026 will trigger a margin call at a major global bank, revealing the interconnectedness of the trap. The private credit time bomb. In the final act, the most acclaimed success story becomes the primary cause of ruin. In 2025, private credit was hailed as the safe alternative to volatile stock markets. But the December 2025's transparency audits reveal a terrifying reality. Many of these loans were made to companies that can only survive at 0% interest rates. With the interest rate conflict of late 2025 keeping borrowing costs at 20-year highs, these zebra companies are hitting a wall. They're no longer paying their interest with profits. They are taking out new private loans to pay the interest on the old ones. This is Ponzi finance at a systemic scale. When the private credit market, which has surpassed $2 trillion in the US alone, stops rolling over this debt in 2026, the defaults won't happen in the public eye. They will happen behind closed doors until the losses are too big to hide. Undeniable. The 2026 margin call on the world. The ultimate final act trigger is the term premium spike. On December 19, 2025, the bond market signaled a loss of confidence in the long-term sustainability of global deficits. As yields on the 10-year Treasury spike, the value of the collateral held by shadow banks drops. In a world of 10-to-1 leverage, A 5% drop in bond prices wipes out 50% of a fund's equity. This triggers the systemic margin call. In 2026, we will see the big squeeze. Shadow banks will be forced to sell their most liquid assets, gold, Bitcoin, and blue chip stocks, to cover losses on their ghost debts. This is why the markets will flash crash even when the fundamental news seems fine. The machine is selling what it can to pay for what it can't. Verified. The behavioral exit, the new gold. The ghost cannot be exercised, it can only be avoided. In the final weeks of 2025, smart money is exiting any instrument that carries counterparty risk. They are moving into bearer assets, assets that are nobody else's liability. Actionable insight. For part 3, identify the linkages, check if you're safe, money market funds or pension allocations are exposed to private credit or alternative lending. In 2026, alternative will be a synonym for illiquid. Avoid the yield trap. If an investment is promising 8 to 10% stable, returns in a volatile 2026 environment, you are the one providing the exit liquidity for a shadow bank. The collateral pivot. In a stage 4 shadow liquidation, the only thing that matters is high quality collateral. Physical gold and short-term T-bills held directly are the only shields against the ghost. The machine has built a $250 trillion house of cards in the dark. In 2026, the lights come on, and the ghost in the ledger will be revealed as the architect of the final act. The social credit pivot, we will expose how the coming 2026 financial panic will be used to force the world into the CBDC behavioral firewall. Subscribe to the revelation, the pattern is absolute. This is part 4 of the 5-part final act series. Having exposed the ghost in the ledger, part 3, we now move into the most chilling transition of the 2026 landscape, the implementation of the behavioral firewall, the crisis as a catalyst. The mechanical reality of a systemic collapse is that it is rarely allowed to go to waste. As of December 20th, 2025, the friction in the shadow banking sector and the sovereign debt trap are creating the perfect conditions for a state-led solution. In the final act, the transition from a free market economy to a managed behavioral economy is not marketed as a takeover, it is marketed as stabilization. We have entered the era of the social credit pivot. Just 10 days ago, on December 10th, 2025, the IMF's updated CBDC Virtual Handbook added a critical new chapter on programmable monetary policy. This isn't about faster payments or convenience. It is about the ability to embed social and environmental triggers directly into the unit of account. In the 2026 landscape, the final act warning is this: your money will no longer be a passive tool of exchange. It will be an active tool of compliance. Check. The 4 stages of the behavioral pivot. To survive the 2026 implementation, you must recognize the 4-stage cycle of the social credit pivot. Stage 1, the security mandate 2023-2024. The system introduced digital identity under the guise of preventing fraud and deep fakes. You were told that to participate in the digital economy, your identity must be verified on the ledger. Stage 2, the emergency integration, late 2025. This is our current location. As the shadow liquidation, part 3, causes a credit crunch, the state offers direct-to-citizen liquidity via central bank digital currencies, CBDCs. This is the Trojan horse. To receive your stabilization credit, you must use the state's digital wallet. Verified. Stage 3, the programmable firewall, early 2026. This is the coming friction point. The state introduces behavioral incentives. Your digital credits will have a higher purchasing power if spent on approved vendors or sustainable products, and a lower value or restricted access if spent on high carbon or non-compliant activities. Stage 4, total financial enclosure, late 2026. The physical cash exit is closed. In this final stage, your social credit score, composed of your transaction history, digital footprint, and compliance with the Great Reset mandates, determines your level of access to the economy. The net zero enforcement engine. In the final act, climate change becomes the primary legal framework for financial control. Latest data from the European Central Bank, December 2025, Green Ledger pilot confirms that they are testing individual carbon quotas. Under this system, every citizen is assigned a monthly carbon allowance. If your spending exceeds this quota, calculated in real time by the AI in your CBDC wallet, your ability to make further to our discretionary purchases is automatically throttled. This is the behavioral firewall. It bypasses the legislative process and enforces policy directly at the point of sale. You won't be banned from traveling or eating meat. It will simply become digitally impossible once your quota is reached. Undeniable. The 2026 deplatforming of the unverified, the ultimate final act warning for 2026 is the eligibility crisis. On December 18, 2025, several major global banks updated their terms of service to include reputational risk clauses. This is the bridge to the social credit system. If the machine's AI-driven sentiment analysis labels you a spreader of misinformation or a systemic risk, the bank can deplatform you, severing your access to the digital economy. In a world without physical cash, being deplatformed is a financial death sentence. The 2026 final act is the moment the machine realizes it no longer needs to use the police to silence dissent, it only needs to turn off your wallet. Verified. The behavioral exit, the parallel economy. The only defense against a social credit pivot is to exist outside the digital enclosure. In the final weeks of 2025, we are seeing the rapid growth of the parallel economy, communities trading in silver, local barter, and privacy-focused digital assets. Actionable insight for Part 4, secure non-programmable assets. Hold kinetic assets, gold, silver, land, that do not require a central server to authorize a transaction. Audit your digital footprint. The data you generate today is the training set for your 2026 social credit score. Use privacy-focused tools to minimize the signals you send to the machine. Diversify your jurisdiction. Do not keep all your capital in one legal system. If your home country activates the behavioral firewall, you need an exit ramp in a jurisdiction that still respects financial privacy. The machine is not just tracking your money, it is aiming to track your behavior. In 2026, the social credit pivot will turn your bank account into a behavioral cage. The Great Decoupling. We will reveal the final timeline for the collapse of the dollar and the birth of the two-tiered world. Subscribe to the revelation. The pattern is absolute. The mechanical reality of the global financial system has reached its point of irreversibility. As of December 20th, 2025, the era of a unified US-centric global economy has officially ended. We are witnessing the Great Decoupling, not just a trade dispute between two superpowers, but a systemic fission of the world into two irreconcilable financial and technological universes. For 50 years, the monolith of the US dollar and Western financial rules governed global trade. But as the clock strikes midnight on 2025, the data reveals a permanent rupture. According to the latest Q4 trade figures, for the first time in the modern era, intra-BRICS